Good morning, I'm Clinton Griffiths. While inflation may be easing, interest rate hikes are not. The Federal Reserve announcing a smaller half-point increase to its key rate. It comes after 4 straight three-quarter-point interest rate hikes. Now, some analysts say it's a sign the Fed is starting to dial back its efforts to combat inflation. And inflation continues to weigh on the minds of many shoppers, especially at the grocery store, including in the dairy aisle, which has seen some of the largest price hikes.
Coverage of the 2022 Milk Business Conference on AgDay is brought to you by AgriFinance. Discover how an unmatched network of local relationship managers and sector experts can help you confront agriculture's challenges and seize the opportunities that lie ahead. Growing ambition. Learn more at raboag.com.
Tyne Morgan joins us from this year's Milk Business Conference in Las Vegas. And Tyne, what's on the minds of dairy producers at the conference?
Well, Clinton, some areas of concern have not changed from last year. That includes higher costs across the board and then, of course, labor. But as you look at dairy demand this year, it has held strong despite inflation. The question is of how those higher costs will impact dairy farmers' bottom line in 2023.
I think the cost of everything and, of course, water issues are huge in California.
Dairy farmers from across the country are wading through the reality of higher feed prices, input prices, and inflation that's impacting their operation across the board.
Well, inflation has reached its zenith. It did so back in March. It's now coming down. The question is, how far will it fall in 2023, and what's the new natural rate of inflation? Back in the last 10 years, it was somewhere around 1.4%. We now think it's closer to 3 to 3.5%, meaning that interest rates are going to be staying higher.
Dan Basse of Ag Resource Company dubbing it the Great Reset, and one that he says is costing farmers more money on nearly every corner of their farm.
If you look at 7th District data, this is the big fat states, the I states in the middle of the country. They are now looking at operational loan costs being at around 6.8%. If you needed to borrow money to buy farmland, it's about 6.5%. This is up about 3 percentage points from last year, substantially. And so whatever your interest rates costs were last year, it's going to be double.
Basse thinks interest rates could increase again early next year.
The great financial reset is happening where interest rates are rising. There's a new asset class called cash. And as we look forward, I think that reset will have a big impact on repricing assets. Not so much farmland, but equities and lots of other things. And farmers need to be aware of that.
Farm Journal's Washington correspondent Jim Wiesmeyer says he's more concerned about 2024 than 2023 in terms of the great financial reset and impact on agriculture.
Later, 2023, I think you'll see some of the pressures start, because as the carryover from relatively firm prices this past year play out, and some of these ad hoc disaster payments are spent, and other farm program payments. So yeah, 24 could be some crunch times, and it has to be cash flow. Cash flow is predominant, and cutting cost.
And Clinton, immigration is another hot button issue here at Milk Business Conference for dairy farmers. Jim Wiesmeyer, he's actually optimistic. He thinks that we can see some movement on immigration policy in Washington in 2023, but he says that has to happen in the first 6 months of the year. Reporting from Milk Business Conference here in Las Vegas, I'm Tyne Morgan for AgDay.